All right. I think we'll get started. We'll probably still have some people rolling in, but just wanted to get everything rolling for the people that already started. Hello, everybody. My name is Brett Com, and on behalf of all of us at Nova Wealth, we appreciate you attending tonight's webinar, Long-Term Care 101, with our special guest, Tom Scarfo of Vanbridge. Tom is an offshoot of our team. He has helped us with all areas of insurance and navigating the products available to us to find the right solutions for our clients' needs. Tonight's webinar will be recorded, so if you miss anything or have some technical issues, which I know we always have, you will have the opportunity to rewatch it at a later date. As mentioned, tonight's topic is Long-Term Care Insurance 101. And with our team's focus on retirement income planning, this is a topic that comes up often. Most of our clients have had a personal connection to the topic with either an aging parent themselves or have seen it with someone they know trying to navigate it. Tonight, Tom will be taking us through all parts of the long-term care insurance, including the need for it, the cost, and the different types of plans available. We'll be placing everybody on mute for the presentation, but at the end, we'll open up the audio for some Q&A. So without further ado, I'll hand it off to Tom. Tom, thanks for joining us.
Thanks so much, Brett. Thank you, everyone, for taking the time to join us this evening. As Brett mentioned, my name is Tom Scarfo, and I am a business partner and client working with Nova Wealth and Jeff and Elizabeth and Brett. And our firm, the firm that I work for, is an insurance brokerage firm. So we work wholeheartedly with Cetera investors and their financial advisors, partnering with them with anything, excuse me, for life insurance, long-term care insurance, retirement planning needs, and disability needs. So anything in the insurance protection area, we have been working with Cetera for many years now, providing consultative services and different ideas to help with the retirement planning process and protection. Today, we're going to talk about long-term care 101. What is it? What types of plans are out there? What types of coverages do these plans cover? Who pays for it? How is it paid for? And how do you make that part of your retirement plan? So without further ado, we'll go right into it. So tonight's agenda is going to be long-term care. What is it? What does it mean to need a long-term care service? What does it look like? Where does it take place? Where does the services take place? Types of care. So what types of care can be offered through these long-term care plans or life insurance and long-term care plans? Who pays for the care? Is it going to be something that you would have to pay for out of pocket? Do you have to maybe liquidate some other assets or money from savings? Do you have to liquidate an investable asset or money that's in a brokerage account or maybe in the market? So how does that care get paid for? We'll talk a little bit about what is covered under Medicaid, Medicare. It's very, very minimal, but we'll go over that. And then the types of plans. If you going back, I would say about 30 years ago, maybe 25 years ago, there was traditionally one plan only. It was a traditional long-term care plan. Today in the marketplace, there have been several policies come to market in the long-term care and life insurance space, the long-term care and annuity space. More and more long-term care providers are coming to market on financial service products such as life insurance and annuities, because a lot of advisors that we're working with, typically their clients are working on or looking at retirement planning and protection planning. So there's also some really good benefits that come along with obtaining a long-term care plan via a life insurance or another financial services product. And we'll discuss the features and benefits there as well. So what is long-term care? So long-term care, essentially, it's a phrase that is synonymously used when a client needs an extension of care in their day-to-day life. Could be for a short period of time, could be an extended period of time, could be lifelong, could be very different depending on the client's personal scenario. Typically, it's a service that a client would need to help them live independently on their own or in the safest possible setting, whether it's in their home, in a facility, maybe it's in a rehab center or assisted living center. And the idea of long-term care is to assist a client after, whether it be a medical event, an accident, an injury, to get back to 100% and get back up and on their feet again. The long-term care is typically triggered by 2 of 6 ADLs. You'll hear a lot of different acronyms tonight, and I'll kind of make sure I touch on what they all are. So ADLs are activities of daily living. And every company that offers a long-term care or extended care benefit does trigger by these 2 of 6 ADLs. So it's going to be eating, getting dressed, transferring in and out of like the getting out of bed or transferring in and out of like the shower, going to the bathroom, continence, and then a significant cognitive impairment. So 2 6 ADLs or 1 cognitive impairment. Cognitive impairment typically would be something like dementia, Alzheimer's, Parkinson's disease. It's typically going to be a diagnosis that is something that would be a progression type disorder, meaning it could progress and get worse over time, or it could be pretty rapidly. So really, in a nutshell, a long-term care is used. It's a very broad term, but it's basically meaning it's a client needing additional care in their day-to-day life because they cannot perform the 2 of 6 ADLs. Okay. Why do people need care, right? Long-term care services are provided to individuals when they need assistance. Again, the 2 of 6 ADLs, bathing, getting dressed, eating, continence, toileting, and transferring, or just the one of the cognitive impairment, a few listed right here. And really, as we're going through this, I really ask, the clients that are participating tonight, really think, because a lot of times, whether it be a one-time injury or event where maybe it's a slip and fall accident where a customer has to get rehabilitation, I think that I'd say a good 75 to 80% of clients that I talk to may not have experienced a long-term care event, directly impacting them, but they know someone or they have a family member or loved one that may have had one of these disorders or needed additional care at a time. So it's really a very hot topic that we're talking about with clients in the market today when they're discussing retirement plans. Excuse me. So with LTC or long-term care, there's several different types of care that fall under the umbrella for care. The first and most prominent and most popular of all of the care is home health care. When I ask a client, what would, God forbid, if something were to happen and you needed extended care, what do you envision that care looking like? I'd say almost everyone states that they want to remain in their home or be in a comfortable spot that's familiar to them. They don't want to have to go into a facility or maybe go into an adult rehab center or residential type center. So home care covers a gamut of different things. It covers 2 major cares, and we'll go a little bit deeper into that in just a minute. But basically, you've got 2 types of care with home care, and that's going to be skilled care and custodial care. I'll talk a little bit more about that in just a minute, but it's essentially going to provide a client services that are going to be both medical and. So what do I mean by that? Like if you have a need for maybe doing some physical therapy where you're doing rehab on a leg or a hip or relearning how to walk after an injury or an accident. So they would provide a nurse or a caretaker to come out, provide that physical therapy, rehabilitation service or therapy in the home. And they would provide medications and things medically necessary to help you recover. It's also going to cover things like speech therapy, respiratory therapy, physical therapy, things like that. There could be therapy, learning how to, and this would fall under physical, but maybe relearning how to walk, or maybe, relearning how to be mobile again after a stroke, for example. So things like that. And that can all be done in the home. There's, again, custodial care and skilled care, and I'll go more into the weeds on that in just a moment. The other care is going to be adult daycare. And it's typically what it is in a nutshell is a community-based care plan. It's typically in a group setting, could be virtually done, could be at a facility. And that could be, different drills and activities that you can utilize as rehabilitation services. Assisted living facility, adult foster home, or residential healthcare is another form of coverage. And that would be an assisted living facility would be a live-in scenario where it's not going to necessarily provide 24/7 medical care. There would be someone on staff for medical assistance. But the idea of assisted living is you'd be in a facility, complex, a townhome with other individuals, and you'd have recreational activities. You'd have the ability for, exercise groups, things like that, activities there. There's going to be some skilled nursing services available and some non-skill stuff available as well within an assisted living setup. And then hospice care is part of an LTC plan, and essentially hospice, excuse me, is end-of-life care. It's going to be usually done at the client's home, and that's typically if a client has a diagnosis that is terminal in the sense of they have 6 months or less to live. So it provides all different types of care, from just injuries to quick rehabs to more substantial care. Hospice care is going to either be done within the home of the individual, or there might be a facility, a medical facility like a hospital or a wing of a medical center that does hospice. And then lastly is going to be nursing facility or nursing. So this is it, medically necessitated care where a client would need 24/7 care. They would maybe need a medical aspect along with a physical therapy aspect, along with maybe a specialty care access. They could also get custodial care within the nursing facility. That would be, of all of the coverages, that's going to be the most in-depth, also going to be the most expensive to pay for as a client. Typically, the nursing home where you're living there, 24/7 access to medical staff with skilled care, non-skilled care, and some social physical activities as well. That would be, of the coverages, probably the most expensive when we talk about what types of care and how much they cost. So now we know what types of coverages are included in a plan for long-term care. Now we're going to talk about how they're paid for. Typically, you've got Medicare, Medicaid, VA options, personal income and assets, and then insurance. So with Medicare, which is it's 65 plus insurance plan, they do offer on Medicare up to a 3-day hospital stay for long-term care, skilled care only. So they'll give you 3 days in the hospital under Medicare, the first 3 days. If your stay goes beyond the first 3 days, the first 20 are covered at 100% on Medicare, excuse me. After day 20, there is a copay, and that's per day up to day 100. So the most coverage you can get from Medicare for a long-term care stay is going to be 100 days of service, and the first 20 days are typically covered at full. After that, the remaining 80 days are going to be a copay of $204 per day for the next 100 days. After the 100 days of service are up, Medicare will no longer pay anything out on a long-term care type claim. So there is some coverage. It's very limited in what they do offer. And what I will say is, if it is a Medicare based stay. Typically what they do when you're in care under Medicare is they work very closely with the medical staff, and they try to get the patient in and out of that within that 20-day period as quickly as possible, because they're paying full on for that, the full amount. So it's unfortunate to say, but a lot of times they're trying to push the patient out as quickly as possible to avoid the excess of what it would cost. So Medicare does offer some sort of coverage, not a great deal of it, but up to 100 days. And there is a dollar amount that does come with it beyond day 20. Medicaid is a federally funded and state funded insurance plan for clients typically that have very little to no assets. I say that because in order to be eligible for it financially, in the state of New York, you can't have more than, I want to say it's 31,000 in assets total. There are some rules and exclusions, but there's also with Medicaid in qualifying financially to get it, there is going to be a 5-year look back. Meaning if you retitled property assets, maybe moved some stuff into a trust, or maybe had done a different estate or trust planning to protect those assets, the federal government looks back 5 years on all of your financials. So qualifying, you essentially have to have a very small asset base in your name. VA benefits are certainly available for any of the veterans out there. With VA coverage, it is going to provide service for long-term care services. I will say this, it might not always be something, there might not be a VA located right near you. So the availability with getting into a VA nearby and then actually getting a bed in a VA hospital for care, that there could be some time associated with that. And then the last two items, personal income and assets. If we don't put together a plan, a long-term care plan, whether it be in the form of insurance or some sort of asset put aside, we do have to liquidate, whether it be, retirement assets, second home, any type of assets, obviously is a way to pay. But of course, long-term care insurance, and that's the reason why we're here tonight, is to talk about putting a plan together so we don't have to worry about what we're going to liquidate or what we would need to talk to, the Nova team in the event we face that. We do need to pay for care at some point. So that's really why we're here tonight, talking about the plan and how to fund it and why we fund it, things like that. So getting back into what does it pay for, custodial versus skilled care, I'm going to go over that. And basically the long-term care coverage, whether it is on a life insurance type product or an annuity-based product, or even just a traditional long-term care product, it's going to pay an income stream out once the client initiates claim. So now we're going to talk a little bit more about custodial versus skilled care. Custodial care is really anything consisting of non-medical care for a client that has long-term care. And to give you an example, the best type of example I can provide would be, let's say you have a situation where you need long-term care and you're going on to the claim and you need some assistance, maybe upkeeping lawn care or yard work, or maybe you need homemaker services, like you need someone to help you get to and from medical appointments, where these are not specific actions of care that are medically necessity, but it's a way to still help our client do the non-medical stuff while they're on a claim. That could be, having someone come in and do, house cleaning, laundry, preparing meals, things like that. It can include some sort of light medical care, like providing medications, getting meals set up, and getting a client prepped, or to bathe and things like that. But for the most part, it's non-medical type care when we're talking about custodial care. And that's really there just kind of help ease the burden of any of the non-medical stuff, because a lot of times you don't really think about that when you're dealing with an injury or an illness. But it is a very helpful type benefit that they do offer. And then skilled care excuse me, is the opposite of custodial care, where it is a medically necessary care that a client needs, whether that be physical therapy, occupational, rehabilitation, speech therapy, depending on the injury, illness, or accident. They will put together a care plan that works for you. Now, when you go on a claim, depending on the care that you need and the level of care that you need, the care done in your home or at a facility. Like I said, I'd say about 95, probably even 99% of people I talk to, for the most part, would prefer to be in their home as long as possible during a situation or a claim like this for long-term care. A couple examples would be like physical therapy in a home, medication therapy, wound care therapy, maybe medical injections necessary based on a treatment plan that your doctors put together. So again, two types of care: skilled and custodial. Skilled is going to cover your medicine, all your medical needs. Custodial is going to help with everything else. It's really going to really help you keep your mind at ease, to help everything else within your life stay put together for you. Now we're going to take a look at the main components of a long-term care contract. What different components are there? So there are 5 major components of each type of policy. The first one being the benefit amount. Now that is going to be the dollar amount that you're eligible to take each month. So you'll have a benefit amount typically anywhere between $1,000 or $1,500 a day are the lower end of the minimums. I think the lowest we could do is $1,500 with most companies in New York. And then we could do a maximum up to $12,000. A couple of the life insurance policies go slightly above $12,000, like $12,400. But we can design it to get that monthly benefit amount anywhere between the $1,000 to $12,000 range. We could design that specifically to each client specifications or needs. So we have the benefit amount. That's what we get to collect on, the dollar amount. The benefit period is the time frame in which we can collect. So if I have an accident, if I slip and fall on ice tomorrow, and I have an accident and I need to rehab in a facility or have someone come to me, I have, based on my benefit period, which is selected before we have a policy issued, you can go from 2 years benefit all the way out to lifetime. The shorter the benefit period, the lower the cost of that would be, of course. But you can do in 2-year increments all the way out to lifetime, depending on the company and the product we're looking at. The elimination period is essentially your waiting period, or as I like to compare it to like a deductible. If you have an accident in your vehicle or a claim on your home, you have to pay the deductible. Same with long-term care insurance. The deductible is measured by days. So it's going to be measured by 0 to 90 calendar days, 90 days being the most common, preset by most of the companies we work with. So you'd go on claim, let's say I have my slip and fall tomorrow and I need to get rehab right away. I would have to pay for the first 90 days out of that. And then I could start collecting on my claim on day 91. So there's an elimination period. And we can also predetermine that up front. We could do as low as 0 up to 365 days. The longer the waiting period or elimination period, the lower the cost of that rider would be. So it would save on some money. But just keep in mind, if the longer your elimination period, the more assets you need to have available that are easily accessible to pay for the care until the elimination period kicks in. Inflation protection policies typically have anywhere between 1% to 5% you could get, depending on the design of the contract and how many years we're looking at as far as to retirement and projection of what the starting benefit amount is. If we were starting with a larger benefit amount, maybe a $10,000 or $12,000 benefit amount in day one, we might not have a need for inflation. But we could also design something with a lower cost day one benefit, maybe 1,000, 2,000, 3,000, and then throw a percentage inflation rider on there. So we have a projected amount that grows within time. And then lastly, There are excuse me, products in the market that are on a life insurance and or an annuity chassis. Some of the added value there is when you put a policy together for long-term care on a life insurance policy or an annuity contract, you've got the other benefit. You have either the annuity where you have a pool of money that you can take income or distribution off of. And then life insurance, where if you don't use the long-term care within the contract, that still passes as traditional life insurance to your family, a beneficiary of your choice, or your estate, however you have it set up. So those are the main components on a traditional long-term care or a mixed use life long-term care or annuity long-term care product. There's a couple other options that I'll mention just briefly in regards to long-term care. One of them is shared care. Some policies do offer joint or spousal coverage, where you could buy a policy that they can share the benefit. So we do a husband and wife, and we could share the pool money. There are cash refund opportunities. So you could basically, if you're looking at an annuity or a life insurance type long-term care solution, we can build a certain policy out that provides a return of premium. Maybe if you wanted to, so if you wanted an exit strategy or wanted to walk away at some point. And then lastly, a death benefit in the life insurance type long-term care specialty products, where you never use the long-term care, you would still have life insurance to pass along to your estate. So traditional, now we're going to go a little bit more in depth on each type of plan. We're going to look at 3 specific plans. We're going to look at a traditional long-term care plan. We're going to look at a life long-term care, mixed use life insurance and long-term care. And then we're going to look at a hybrid policy, where it's typically going to have multiple options. One's going to be life insurance, one would be long-term care. And then we'll look at some of the cash value options, like a refund of premium. So we'll look at all those different types of plans, and we'll take a snapshot at each one. So a traditional LTC is probably the most flexible design out of all of them. And what I mean by that is that we can really customize this however you want. We can specify a dollar amount day one. We could specify a certain dollar amount at a certain age. If you said, hey, I want to have Elizabeth or Jeff or Brett, I want to have $10,000 by the time I'm 80. We can customize that using a traditional LTC plan. And we could work in that calculation to figure out what it would cost you day one to project out a certain dollar amount at a certain time frame. Can be funded with HSA dollars. So not a lot of folks know that. And it's pretty cool because the cost of LTC can be used to fund HSA dollars if you have an HSA account. But it can be used. And then the only thing I always do say with that is just check, please consult. We never provide tax advice, but please consult with a tax consultant or an accountant if you are looking at using HSA dollars, just to make sure that we are within the limits that are set forth in the state that we're in, and whether it be New York, New Jersey, Florida, wherever you are. Premiums potentially can be tax deductible. I say that very lightly because there is a loophole where just long-term care can be deductible, and there's certain limits in the state of New York. So for example, if you have a long-term care premium that's $5,000 annually, there might be $600 of that you can deduct every year. It's not the full amount. Again, I always recommend to speak to your accountant or your tax professional on what tax savings you can deduct when you do your annual taxes, because there is a chart set forth by the state of New York and then every other state. The benefit, of course, we can customize that to your liking. Inflation, we can customize that from 0 all the way up to 5%. And then we customize the services. We could add different things like home health care waiver of premium. So that means, or excuse me, waiver of elimination. Meaning if you have home health care, you don't have to wait the full 90 days. You can take a cash payout in lieu. It is a much smaller cash payout, albeit, but it is a much smaller benefit payout in lieu of waiting the 90 days. And we'll look at that in just the next page here. So this is actually a traditional long-term care quote for a male and a female age 65 in the state of New York. And what we did here is just ran a 4-year benefit period. So 48 months of care. So if client has an injury, illness, or disability, they can go on claim, again, triggering 2 of 6 ADLs. They can collect $5,000 maximum monthly up to 48 months. The total amount would be $240,000. Covers 100% assisted living, 100% home health care. And as I just mentioned on the previous slide, there's a cash benefit, which is elimination, and it's called the waiver of elimination cash refund. So if you wanted to have home health care, it gives you a 25% payout of your full allotment. So it is a very smaller, watered down version, which you can get as a cash indemnity payout, meaning you qualify, you'll get a check for $1,250 every month, but you are leaving at that point $37.50 on the table each month. So this is the coverage in regards to benefit amount, benefit limit and time frame, coverages, elimination period, and then the next page we'll look at the premium. So in this case, we're doing a joint husband and wife, and we're doing, because this is a joint combined policy, the company, Mutual Omaha, does offer 15% partner savings for both insureds. Total combined monthly on this would be $702 a month. And then your premium breakdowns are right over here. Again, this is traditional long-term care. I will say this, it is the most flexible, but in the sense of coverage and benefits, it has a long-term care benefit on it. It's got the home healthcare rider and coverage, assisted living coverage, nursing coverage. But if none of those coverages are used for long-term care, the policy does expire at death. So I do want to mention that is it's not designed to pay for anything but long-term care expenses. And again, this is something that premiums are set at time of issue, and premiums are not going to be locked in for the levelized time frame for lifetime. So with this type of plan, these premiums can go up as we get older. I always like to mention that just for full transparency, because some of the other options do come with pricing that is guaranteed and locked in and never go up or down. So again, this is the Mutual Omaha traditional husband and wife. We got a 65-year-old. Maximum they'll go out to issue age on this would be 75. And that's that's pretty straightforward with most of the carriers we work with. 75 is typically the age range, the max age range for new long-term care. There's a couple outliers out there that go up to age 80. Next type of contract we're going to look at is going to be a hybrid LTC. It's typically called a linked benefit policy, a hybrid. It could be a life. Now, this is going to be a life insurance policy with an LTC policy. Could also be an annuity-based policy or contract with an LTC or living benefit rider on it as well. Not really as flexible, a little less flexible on the premium design. There's typically only a short pay design. So you do a one-time payment. You could do a 3-pay, a 5-pay, 7-pay, or a 10-pay. The way it works is you have a set forth premium, and it's the premium on this would be guaranteed for life. So if you did a 10-pay and we did $1,000 a month, be $12,000 a year paying into it for 10 years, or we could schedule it for 7 years, as little as 1 year. There are potential tax advantages of using this plan for a couple different reasons. The LTC portion, so the payout or the death benefit of life insurance, both pass tax-free, those benefits. If we're looking at a life insurance contract, we can build something out with a cash value accumulation. So we can look at something that's going to provide tax-free death benefit, a tax-free long-term care rider, along with cash value. So there's a couple different opportunities as far as leveraging either the death benefit, LTC, or maybe taking money out of it. When we design a hybrid policy, we've got the ability to do a level payout, or we could do an increasing or an inflation rider. The inflation on hybrids are typically 1, 2, 3, 4, or 5%. Most commonly, we do a 2 or 3% inflation. Services are all the same: home health care, assisted living, nursing home, adult daycare, hospice care. And another real big thing with using an asset-based investment type LTC plan is we could consider using another asset and repositioning that. So excuse me, what do I mean by that? Let's say you've got an old whole life policy or an old life insurance policy that maybe has some cash accumulation built into it, and you don't plan on taking any money out, and you don't necessarily need the death benefit. We can leverage old cash value from old life insurance contracts. We could even look at taking assets out of older annuity contracts that we're not going to use for income or distribution in retirement, and then take those and roll them over or move them into one of these hybrid LTC or hybrid life annuity contracts. So we could reposition old policies that are out there that have cash value that we might not need. Next page, we're going to take a look at one of these contracts looks like. This is a contract for a 65-year-old client. And in this example, we're looking at a policy which is through Nationwide Life. And this policy is called Care Matters. And this is a life insurance long-term care hybrid. And in this particular example, what we're doing here is we're assuming the client does a one-time premium payment. And in this particular example, we're using $100,000 that the client has in a brokerage account. It's there. It's kind of like a rainy day fund. He's got it earmarked maybe for savings for an emergency. But we discussed, hey, we can leverage that asset that you're earmarking for, an emergency or rainy day fund, and we can leverage the insurance piece, and we could potentially turn $100,000 of money at cash on the sideline in a CD or a savings account, and we could double that as far as a long-term care benefit goes. So we essentially reposition this $100,000 from a brokerage account into this contract for this client, and he has $226,000 of long-term care basically overnight. So by the time the policy issues, we deposit the money. It generates a pool of money about 2.25 times what he puts in. It does have a 3% inflation. So the day one benefit is going to be the monthly benefit amount. And they do use a couple different acronyms. It's just acceleration of death benefit for qualified services, and then the long-term care acceleration benefit. 4713 is the day one amount, but that will increase every year by 3%. There is a specified death benefit amount of 113. So if the client were to pass away before taking long-term care out or surrendering his cash value, the death benefit would pass to the estate or the beneficiary in the amount of $113,123.70. That's a tax-free benefit, as well as these benefits that are passing from the monthly LTC. Those will pass tax-free as well. And then lastly, the policy with Nationwide offers a guaranteed minimum DB, and it's always going to be 10% of the initial death benefit amount. So what that means is that the client can withdraw essentially all of their specified amount minus 10%. So there would be a leftover or a residual minimum death benefit of $11,312.37. 10% of that original amount. And this is not the same with every company. It's very unique to the way Nationwide has their policy set up. Some companies allow you to exhaust the entire pool of money. That's going to be personal preference based on the insurance company. Then the next page, this is actually going to show us the numbers of what they look like. We've got the gold side here, this is going to be our premium schedule. So we deposited 100,000 one time. We immediately have a cash surrender value, which we could take out. You could essentially get up to an 80% return of premium through 10 years 10. So if you wanted to walk away after 10 years, you can get 80% refund of premium, walk away, and you would forfeit any long-term care or death benefit. After year 10, it does go up to a 95% refund of premium out to life expectancy. And then after life expectancy, which is 88, 89, it kicks up a little bit and starts increasing a little bit. By the time you get to age 100, typically you have a full net surrender value, plus you'll have a profit of a small amount of that time. So this is your cash growth in the first two columns here. This is your death benefit. This is your insurance benefit that pays tax-free. All of these values here under the gold are guaranteed at 2% interest. And then under the blue section, these are your LTC numbers, your total pool, your monthly benefit, and then your total pool with the inflation 3% amount. And again, these are all fully guaranteed. I just showed on these two screens out to age 105, but these go out to age 121. So there's essentially no way you can outlive this. And with this contract, this is truly a set it and forget it. You make the premium deposit one time, and the policy is there for when you need either long-term care benefit or for the death benefit payout to your beneficiaries. So that's a hybrid. Again, this is on a life insurance chassis, and this can be looked at either on a life insurance with LTC combination, or in some states, they offer annuity and an LTC combination as well. Last item we're going to look at is going to be traditional life insurance with a rider that provides LTC coverage based on the death benefit. So there's flexible protection in a couple different aspects of the death benefit amount. We can specify the dollar amount we want. We could specify the premium schedule. So typically with traditional life insurance, we can specify if we want to do a flexible premium schedule. So we can pay it over clients' lifetime to age 85, 90, 100. We could pay it for 10 years. We could pay it for 15 years. We could pay it for 9 years. We could pay it however you want. So it's very flexible in how we can set up the payment structure. Life insurance and the LTC coverage do pass tax-free. So again, excuse me, the two of 680Ls are your trigger. You have this policy and you've got a death benefit, which also doubles as your LTC or living benefit. We'll take a look at that on a proposal on the next screen. But all the services are the same: home health care, assisted care, assisted living care, home, nursing home care, adult daycare, hospice. Premiums used for LTC costs are fully locked in and guaranteed. That is the same with life insurance. So when you buy a contract, whether it's a life insurance with LTC or an annuity with LTC, you're guaranteed locked in that premium rate, cannot go up or down. And then, the most important thing is that with a life insurance policy and a long-term care living benefit, there is a tax-free benefit that will pass, whether it's a death benefit, it's a long-term care benefit, or whether it's a cash surrender of the policy. Those three options that you do have with the traditional life insurance and long-term care combination policy would all pass tax-free. Now, this is an option that we're looking at, and this type of policy is what's called the universal life policy, meaning it is a permanent life insurance plan. And what we're doing here is we're breaking down the coverages based on a $250,000 death benefit. So the initial lifetime death benefit for this policy would be $250,000. However, we added on a living benefit rider and Prudential this is Prudential Life, and they offer a chronic illness rider for living benefits, for extended care needed, for long-term care needed, and it's a portion of the death benefit. So it's typically the same $250,000 of death benefit is the pool of money for long-term care. And it's dispersed at 4% per month. Client can take 4% per month or $10,000 monthly maximum benefit for day one. There is a 90-day elimination period on this. There is the opportunity to take a smaller amount. Client does not have to take the full amount. At the maximum allotment, 4% per month, you could take 25 months of coverage at $10,000 a month, and you can exhaust that full $250,000. Can also take a smaller amount up to that $10,000 in any given month. So you can take anywhere from 1% up to 4% of this dollar amount every month. And if we did 2%, for example, we did $2,000 a month. I'm sorry, $2,000 would be 2% would be $5,000 a month. If we did $5,000 a month at 2%, we'd have a 50-month payout instead of a 25-month payout. And then this is the structure, the pay structure. On this particular design, we did a life insurance contract with client paying premiums for 10 years. Premium is $14,213. Guaranteed to never go up or down as long as those 10 premium payments are made. There is a contract fund with a surrender value attached to it. So there is cash liquidity. Client can take money out of this, can borrow against it. And there's a $250,000 day one death benefit with the current rate. Now, this is using a variable universal life. So there are different components of cash growth potential for a client in this type of policy. So it could grow the cash and grow this death benefit as possible. The one thing I will point out on a life insurance with long-term care is your death benefit pool is always going to be the same as your long-term care or living benefits pool of money. That's all going to be preset up front when we issue the policy, and it's going to be predetermined the dollar amount payout. So to be for this example, we're doing $250K of death benefit with a 4% $10,000 monthly long-term care payout for up to 25 months. If the long-term care on any of this policy is used, it's a reduction on the benefit dollar for dollar. So for example, we take out, let's say we take out 10,000 for 10 months, and then client goes off claim, they rehabilitate, they no longer need coverage or care. Their reduction would be about $100,000 for 10 grand per 10 months. They'd have 150 in death benefit left and 150 for another future long-term care living benefit claim. And then again, this is guaranteed for lifetime. Prudential Life, another carrier that does go out all the way to age 120 for the guarantee. And as you can see, the longer this stays in force, the numbers can really generate some good cash value returns in this policy.
Well, without further ado, again, thank you, Tom, for
Thanks,
joining
guys.
us tonight. Right, and everybody, enjoy your night.